So we'll just start from the beginning. This is a new page. So okay, we're just gonna do that. So a calendar spread is a neutral strategy, basically. What that means is that you have two sides. So it's pinned to one strike, basically. So what that means for us is, let's say you're trading Coca-Cola, and Coke is trading at $48.27. You think that Coca-Cola by February or June 2022, Coke will hit $50, okay? Or $55, basically, if you are getting risky. But this is near $48, okay? So what you do, you are thinking, okay, I'm going to buy the June. So basically, if you're going to give yourself more time, usually what you want to do is like you want to try to get a year or 6 months out as a calendar. And that's what I do all the time for 6 months out. So what I do is that I basically buy a long call. Okay. So I'm buying the long call. And since Coke is liquid, Coke has weekly and monthly contracts. Okay. And since you're selling the 50 strike, we're trading at 48. Basically, if you just get $48, $50, you also have to sell the same strike at 50. And that's a definition of a calendar strike. You basically are shorting the front month, which the front month or front week you bought it at. So let's say you bought it for next week out, and it's only let's say it's $47, but the long call is worth let's say $5, basically. So what does that mean? So basically you are taking the difference between $5. So $5 minus 48 cents, it's $4.52. This one right here, you are short. Okay, you're short on that, but you're long on this. So that is $4.52. However, this right here, if it loses value over time, so you will collect $48. And assuming this is next week's expiration, that's how much you are going to collect if it expires worthless, but you keep the long call. You don't have, this is a poor man's covered call strategy. There's another one called diagonal, but we'll go over that next week as a continuation. But that one, just a preview, is like you're selling a different strike, basically. So this one's the June one. And this one is next week. So this one, June 2020. This one is December 1st. Okay, so here, how do you make money? You need to buy a strike in the back month, use your league. You pick a stock where the stock can go to, pay whatever premium you are comfortable with, and you can buy as many contracts you want. For example, stock A is trading at $25, but you think it can go at 40 in a few months. So you buy a leap strike for September 22nd for $3.50 each. However, you know this is expensive and this stock has weekly and monthly options. You decide to sell the 35 strike for December 18th, 2020 for a premium of $70 each. So thus it brings your cost average down and you make money by the short strike through data burn by the value of the long option goes up. You collect the $70 or 70 cents or $70 per premium per contract at expiration when the short contracts, the front month expires worthless. It's also good practice to keep rolling them to the next month. So that way you can still collect premium and you're still net long. So, and that's what you do to make money. So they're all pinned to the 50 strike. And one thing you really need to know is like, I'm assuming that you're still selling the 25 strike for December. So short 25 front month, 25 short back month. So if we go less than 25, you lose money. Above 25, you lose money. But in the sweet spot between 25, you'll make money. But usually that's not the case because this is idealistic. It's more of you're just going to keep rolling them with more potential profits to the upside or downside. So how do you kind of know like what to look for? So if you kind of go and look at it, mostly because the 30-day IB is kind of important. So you want to like pinpoint stocks that seem expensive. So, so in this case, a calendar spread provides opportunity to trade horizontally, skews at different levels in volatility. The horizontal skew is the difference between implied vol and the difference between various expiration dates. The goal of the calendar spread is to take advantage of expected differences in volatility and time decay while minimizing the impact in the underlying security. So it's usually the day like you need like an IV above like 40% or something like that. You know that stock is so overpriced and it's just worth it to sell premium against it. Once your call is in the money, like if you bought Snapchat or Neil at when it was only $14 and you bought for 2 years out, you're set basically. Like you can sell premium against that, and then you don't really have to own the shares to do this. So like you can continually keep rolling the short strikes, knowing that you have that long call for 2022, and you can still collect income from this. So this is an income-based strategy. So, and that's about it for a covered call. If you guys want more examples of a covered call, then I can show you one I'm in right now. So I do have an XLF. Hold on, let me just see what I'm doing. Okay. Yeah, this one's not working. Close. or deal with NASDAQ right now. Need a trend. Austin's late. But if you guys have questions, feel free. Because a calendar seems confusing, but when you keep doing them over time, it makes more sense. So just ask questions. So I gotta check what's my margin holding right now. I can tell you guys. Credit spreads. Curious, I kind of explained that. So you have to go back in the videos on credit spreads. But basically what a credit spread is
Yes, I'll find those credit spread videos because that was a couple of weeks ago, and we'll send those over to you.
Yeah.
Unless that was a specific question.
Yeah, today we're just going over calendars, and I'm going to show you an example.
And technically, a calendar is a credit or is a debit spread, but
yeah, it's technically a debit spread, and until you get into like diagonals, which is like more of a credit spread, but it's still picking a direction. So calendar spreads, you can have a double calendar spread. So if we do so a double calendar spread looks like this. So instead of looking like this, we have a structure that looks like cat dog, basically. Alright, so I actually have a very long calendar spread, which is I'm currently down on the short strikes. But if we check it out, I'm bullish on the banks, basically. I'm thinking maybe we'll cover in 2020. So we can look at that. So basically, this is what it looks like. So if we scrunch it up. So as time goes on, the short strike is supposed to make less money. So I'm supposed to be collecting the short strike. So whatever profits I get from the short strike, I collect all that. But the back month, I'm just waiting. So my max profit for this one is $150 because it's pinned exactly at $33. What if we did a double calendar strike? So we just go to XLF, and then we can just look at double calendar. So double diagonal, do this. So double calendar. So basically, you can make your own this is bearish. So we'll take a look at that. Okay, so we don't want that. So basically, this is a bearish trade that cost a lot of money. Double diagonal. So it's saying if it's out here, remember when we have that calendar, it's pinned to in the center where you can make money. This is saying if it's out, this is where you will make profit. So let's take that. So here, money, if it stays inside between 25 and 28, this is where you lose money. And look at the margin requirement for this. This one's huge. So if you're just doing two, basically. So here, money. Down here, no money. So you have to be careful about that, which side you're picking on. Are you picking a side that's sell premium? Or are you picking a side thinking, okay, I want to gain premium? Because basically what a calendar is, it's like your long stock. So this is how much it costs, $3,000 for collateral. No, I'm just using my margin. But if we say we're doing a debit, it doesn't cost us that much because a double diagonal is basically, okay, one side loses money, other side doesn't. So it doesn't take any collateral. Again, you have to plan this out, your strikes. So your max profit is still 150. Does that make sense to anyone, or?
It does to me, Tiff.
Okay, so we're gonna give.
Well, that doesn't help that it makes sense to me. I need everyone else to say it makes sense to them as well.
Yeah.
Auntie said it made sense to her, so that's a plus. And Junis also says it does, so yay.
Sorry, that was me. Okay. So you can just look up like how to do a custom calendar. Okay, so we can do a double calendar. So let's try playing with this. We're gonna do 25, 25. So this is what I meant. This is double calendar. This is your risk to reward ratio. We're thinking, oh, okay. That's what I was saying. Like, that's how I normally see double calendar spreads. They look like cat ears. So when you make them wider, basically, like if you go 23, 23, you make money here, and then you make money there, but it's not worth it. So basically, the back month makes money. The front month doesn't make money. So it's the same thing. It's just how you balance it out. So double calendar, combination of two spreads. This strategy involves buying out of money calendar and out of money call and put calendar around the underlying strike. The result of the trade is simple to neutral calendar, but instead having a profit peak at one strike, it's designed to potentially profit a wider range. So when there's an increased volatility, that's when you start making a lot of money. So you paid $72 for the double calendar. You're risking $72 for a contract. So all that about managing it, you need to manage it like separately. So if the one you're shorting right here, so let's see this one, you're shorting this one, you're shorting the 27 and the 23 for the front month. All you're doing is managing those. So let's just take that to somewhere like something more reasonable. So the back month is March 19th. All you're doing is you're just collecting premium on the front months. But you also have to consider, okay, so if we're trading at 27, what is XLF trading at right now? $27. We will adjust, basically. So we'll adjust it to a point that might be possible. So 28, 28. 23 XLF. So this would be, so the front month for the 28 would be shorted. So basically you're going to be collecting December 4th premiums. So if we look and just look at December 4th, it seems that it's $14 a premium. And then there is no premium for this one. So this wouldn't be worth it. If there's no premium to short, basically, you're never going to get filled. Because there has to be a bid on this. And there's no bid on it, there's no point in doing it. So that won't work. So that means we have to go closer to maybe, let's do 26.5. So 26.5 has one. And it looks skewed. It doesn't look like cat ears. But it should look like cat ears. See, this is what TD shows you. It should look like cat ears. So example of a double calendar, 2 weeks duration, purple line at the blue line. Note the shape in the smooth curves forming a bell curve, 1 and 2 peaks. As shown idea, this calendar are at the 80 and 85 strikes. The overall risk is $72. Because further out options, you are purchasing more than the same strike, shorter duration that you're selling due to time. If volatility rises from initial levels, the potential profit increases as shares within a reasonable direction of either strike. As long potential benefit for long trades. Another benefit is long trades, so the long strikes you actually bought, they increase in value as volatility goes up. So that's just calendar. It's just 2 peaks. All you're doing is, all you have to do to manage that is you're just managing your short strikes. So remember the cat ears. These are all probabilities, basically. So you have this is the short strike. This is the long strike. So you have to place it where you can have this even shaped cat ears. So we screenshot that. Let's do the 9 cat. Make everyone happy. So just remember that a double calendar is a cat ear kind of strategy where you just manage the short strikes. It's the same It's the same thing as when you have one single calendar. We only have one peak, but now we have two peaks that you have to manage. Oh, okay, so I learned something too. So you can edge this by doing iron condors to say neutral. So in between these areas right here, so you can actually make this an iron condor per side, because like when you're short, you can just do, oh, this side, I can short both sides to do iron condor. That's new. So that's about it for today. So one topic per week. If you guys have any questions, or if you want me to talk about bonds again, or what the bond market is pricing in, you guys can ask. Otherwise, we're done for today. So that's all the material I have for you guys, because I just want to do one and let you process that per week.
I like it. Austin should be on in just a few moments, and we'll be good to go into that. Hey, Tiff, calendar spreads for those that are listening. Junis, I know you absolutely love when we do spreads conversation. Michael, I know you use them on a regular basis, and I see you online. We really do appreciate this, Tiff. Exactly what she just said, right? You've got a calendar spread, which is basically a neutral stock, right? I don't think that this price is going to move, or at least I think it's going to end up back exactly where it was. And then a double calendar spread, which is, I think it's either going to be the high or the low side over a distance of time, which is really cool about calendar versus a normal spread, a vertical spread, right? Because a vertical spread is same expiration, two different things, as opposed to calendar, which is I really am buying myself time. And then she caught it right at the end, which was perfect.
Right.
Using an iron condor to hedge at the end is amazing.
Yeah. And then at the same time, I just want to, you brought a great point. As you keep rolling and rolling over time, like, the long strike does have time decay, but you made the majority of your money rolling over every week or every 2 weeks, basically the same strikes, or like doing a diagonal, which is something I will cover next week to like build on top of it. You you basically haven't lost anything if you get a long duration. And so like this is a advantage to you, because I think way back we had a calendar strike. So let me go into my trade statement, and then we can look up R. So I didn't do anything with this one, but I knew that this is a slow mover. So we'll just do, okay, so I think I tried to roll this one. So what I did is I bought a calendar, and then I try to cover it and then roll it. So I think that's what happened, but I was not able to. But this is a way for you to build your portfolio just using calendars if you have a long-term bias. Like let's check R. So look at R right now. So I want long on R on October. I didn't know when we were going to hit. And I knew that they had contracts for May. Okay. I knew they had contracts for May. I bought this one for $3.90. Okay. And I sold the 60. If I let that expire, that would have been netting me $60. So I will keep selling the same strike to net me more profits as the month goes up. And if I'm in the money, that's when I start selling out of money contracts, because then it turns into a free debit spread. So I can do this. So let me just show you guys. So I'm not going to buy this again, but I can show you if I had it, basically. So we're going to do January, and then we're going to do the 60. So basically, this would be a diagonal, but notice that I don't have to pay any upfront any collateral for this one, because I'm already in the money. All I have to do is keep collecting profits. So that's what you should keep doing. You shouldn't let your contracts sit. And since I have one in the money, so I have Val currently in the money right now, so I can do this. I think this would be a good example for the people. So this Val contract, so Val right now is in the money. I got a 2023 contract, and I bought it for $175. Basically now, since I bought and the price has increased, I can look to sell weekly premium. So I will have to start planning which one to sell. And if I find one that I like, okay, if I think like this ticker moves too slow, I probably will pick the 14 strike and I'll sell it. Because I know for a fact, I have the 2023 contract. I'm going to keep that one. And I'm just going to keep selling premium every couple weeks, because I'm trying to seek out the best return for my strike. Or like I can just do like the 23 December 18th next month, and then I keep rolling that until 2 years from now this is finally paid off. But the coolest thing is that, in maybe in 3 years, like if we look at Val's chart, there's potential for this stock to go back to at least $20, basically. So I'll keep doing that. And that's a strategy that you want to try, consider using for long term. You can buy the stock too if you want. But this is a cheaper way of doing a poor man's cover call, earning passive income per week. And per week, we are going to, I might do something as in, we're going to keep a spreadsheet for credit spreads. I'm still developing that right now. And I'm still trying to develop new materials for people, so that way I can be organized and people can track me, and there's more things to come to better help everyone learning. Okay, so that's my tangent. If you want to add on, go ahead. If you guys have any questions, you can always contact me.
That's perfect. Like I said, guys, we should see Austin here in a few moments. Thank you to Tiff always for teaching some really great spreads conversations, and kind of covering what we need to from that place and organization.
All right, so cool. How many people are in here? Okay, yeah. Mostly it's just a few people. And everyone's just wants Austin. Like basically, it's always